TCS numbers that should be flashed for you just on the screen. A quick run through of the expectations. We are working with a dollar revenue growth of 1.2%, a constant currency growth of 1.7 to 2%, with margins coming in at 26.7%. The bottom line is coming at 8,110 crore, which is in line with expectations. So that would mean a growth, that would be a bit of a growth on a quarter-on-quarter basis. So that's on the bottom line. 8,101 crore is what the company's delivered by way of the bottom line. We'll just wait for that to get flashed on the screen. This would imply it is a growth of close to about 2.6%. It's largely in line with expectations on the bottom line. Sorry, there has been a correction, 8105. So just slightly lower than our expectations. So it misses our expectations by 80 to 90 crore, but that's on account of the rupee movement. The key to track will be the rupee revenue. Rupee revenue has come in at 37,338 crores. So that too falls short of our expectations by close to about 400 odd crores. So the top line too has missed our estimates marginally. EBIT has come in at 9564. That is actually significantly lower than expectations. So 9564 would imply margins of close to about 25.6%. which means a decline of 90 basis points on a quarter-on-quarter basis. The street was actually working with flat margins. Compared to that, the margins have come down by 90 basis points. You know, a little bit of a decline in margins would have been acceptable considering there is a large element of a cross-currency headwind, which would have hurt the company's bottom line. But even that apart, I think the margins would have come in lower than expectations. Constant currency growth has come in at 1.8%, and this is bang in line with expectations. So a quick run through on the numbers. Constant currency revenue growth of 1.8% in line with expectations. This would imply that growth has slowed down compared to the prior quarter on account of seasonality. This is a seasonally weak quarter because of year-end furloughs, but a 1.8% growth this quarter would fare better compared to what the company did in the December quarter of last year, which was a 1.3% growth, which gives you a sense of the accelerating momentum. However, on the other hand, the margins at 25.6% is a decline of 90 basis points on a sequential basis. Again, it would be hurt on account of cross-currency, but still lower than expectations, and that is driving a minor miss in the company's profitability as well. We are also getting the digital revenues on your screen. Digital revenue contribution to the top line is coming at 30.1%, which compares with 28% in the prior quarter. So digital continues to accelerate. I'll hand it over to my colleague Kritika, who's at the TCS house. Let me try and get if she has some more information. Kritika?
Well, Rima, okay, I'll just take you through the headline numbers. I think you have all the headline numbers already, but just running through it very quickly. In IFRS dollar terms, 5,250 crores in revenue terms. So on constant currency basis, on a year-on-year, 12.1%, and you have the Q-on-Q figure as well. Margins, as you were pointing out, had come in at 25.6%. I've just gotten the exact breakup in terms of the fine print as well. So this time around, the number of 100 million customers has gone up by about 8 points. In terms of the digital revenue, they say that on a year-on-year basis, they've actually seen digital growth by up by 52.7% on a year-on-year basis. If you break it up in terms of, again, we just have the year-on-year performance. The growth in UK has come in at 25.1%. The growth in Europe is coming at about 17.6%. You had the constant currency figure, that's 1.8% of growth Q-on-Q basis. In terms of the breakup, again, BFSI growth has seen acceleration, 8.6% year-on-year. UK and Europe, I just pointed that out. They say that they have seen a continued investment in organic talent development, industry-leading talent retention, IT services attrition at about 11.2%. So that's a broad breakup. I'll go into the retail breakup as well now. The revenue breakup by industries and by markets as well. So I talked about BFSI, that's about 8.6% on a year-on-year basis. Energy utilities, 18.1%.
Kritika?
Life sciences and health.
Sorry to interrupt. Do you have the dollar revenue number with you?
Yes, Rima, we have the dollar revenue number with us. That's $5,250 million in Q3, up by 9.7% year on year.
Okay. Go ahead. You were telling us about the other details as well.
Yeah, so I'm just going to quickly run through the exact breakup. Rima will be able to help you with the exact Q-on-Q figures. We have the year-on-year figures in the press release. So, life sciences 15.7%, communication and media 10.8%, and retail and CPG 10.5%. If I further break up the revenues by markets, I'm trying to look at US. Okay, so UK, Europe, Asia Pacific led growth. North America grew by 8.2%, and India grew by about 9.7%. Again, this is a year-on-year comparison. India is typically sluggish, so I wouldn't expect much of a growth on a Q-on-Q basis. Latin America saw about a 7.6% growth. I have about 3 different papers with me. I'm trying to figure out the volume growth, but quickly let me also talk about the dividend. They have announced a dividend per share of 4 rupees. And this was something that we were also expecting. I'm just quickly reading out the statements from the management before I toss it back to Rima. The CEO of the company says that we are wrapping up 2018 on a strong revenue growth of 12.1% in December quarter, which is the highest in 14 quarters. The strong client metrics, industry-leading growth in digital services, and a strong order book and deal pipeline are all validation that customers recognize our differentiated capabilities and are picking up for the growth and transformation projects. No cautionary points here, but he did say that on a secular basis, as large segments of the economy continue to go through a churn driven by digital, they are creating opportunities for us and the investments seem to be paying off. So yes, there is a little bit of caution on the headwinds from the CFO. The CFO of the company says that despite headwinds from the rupee volatility against various currency, higher cost of doing business in some major markets, operating margins have been resilient. So it seems like they seem to be, again, sticking within that margin guidance range that they had been pointing out, Rima, but we should have...
Milan Desai of IIFL is here with us. Milan, net, there are no positive surprises. Constant currency growth has come in at 1.8%, which is in line. The digital revenue growth has been strong, 52.7%, which is slightly lower than what they had in the prior quarter, which was a 60% growth. So digital continues to keep up pace. There is an acceleration in BFSI, so that's happened for the second consecutive quarter. 8.6% growth on a year-on-year basis versus 6.1%. But these are largely, I guess, already expected by the street. There is a bit of a miss which has come in on the margin front. So net, how would you read the numbers?
Yeah, so basically on the dollar revenue front, it's actually in line with our numbers. We were slightly over the 5,250 mark in US dollar revenue. So we are set over there, and the constant currency growth also is largely in line with our expectation. But margin is something that we see that there is a miss, and probably this is slightly because of other SG&A expenses going up a little bit. How much
the cross-currency headwind
margin we need to see?
Actually, the cross-currency headwind on the top line itself is 110 basis points because the company's reported 1.8% constant currency growth, while the dollar revenue growth has come in at 0.7%, which means the cross-currency headwind on the top line itself is 110 basis points, which I guess is eating into the company's margins as well, Milan.
Yes. Further, just on the margin side, any particular details that we can get, that would be worth looking for.
Okay, Milind, would you be concerned about margins coming in at 25.6%? You know, there has been an aspirational band, yes, that was between 26 to 28%. What range would you give it? Would you expect it to come in by the end of next fiscal or by the end of this calendar year? What timeline range would you give this?
So, based on our estimates and looking at what we have right now, we were expecting, say, about 50 bips drop in the next quarter. Again, that we'll have to relook and see how much adjustment happens, and then probably bring it down for FY19.
Dipesh, what I wanted to understand from you is, do you believe that the order book that TCS has had so far will be able to offset the kind of headwinds that they are expecting to see in Q4 as well? And would you be concerned about the digital growth? Incrementally, it is slightly below what some expectations had outlined.
So I think their order intake remained robust for last few quarters, and I think numbers are also, if you look from constant currency YOY, seems to reflect continued momentum. From number, I think disappointing part remains on the margin, but I think also if I look from constant currency hit and other thing, I think broadly they remain within the guided range. So how I would look overall number, I think broadly inline kind of thing, bearing margin where they have seen some slight miss, but otherwise I think broadly inline number.
Okay, broadly in line according to SBI Caps. We also have Sanjeev Hota of Sharekhan joining in. Sanjeev, when the stock is put in this kind of an outperformance, it's rallied 40% in the last 1 year. It's outperformed the Nifty IT. It's still the most expensive IT company trading, at least in the tier 1, trading at 16.5 times FY20 PE. Can any miss be tolerated? How do you expect the stock to react tomorrow?
Yeah, definitely this quarter performance is softer than what we have anticipated. Though top line was 1.8% broadly with the estimate, the margin performance is not up to the mark. So I believe that stock could react negatively in trade tomorrow, given that the kind of performance they have delivered. But I believe still the TCS remain one of the most promising stock among the top tier IT companies, the kind of growth visibility and the strong order book they had. So it's among the top promising company among the top tier IT companies.
Okay. Would there be any change in your EPS estimate, Sanjeev?
Yeah, we need more clarity on the margin side because management has also commented the cost of doing business in US is going up. So what need more clarity on that, and how much the margins is from the currency impact and how much from the cost of doing business in the US. Need more clarity on that. After that, we will take a call on the margins. But looking at the margin performance this quarter, there could be some kind of tinkering need to be happen on the estimate going forward.
Milind, a very, very quick point from you with respect to the macro issues that are there at this point in time. UK seems to have performed and Europe has been performing, and that seems to have been the trend over the last couple of quarters. But would you expect headwinds in UK and Europe to affect them? And what's the general sense that you're picking up with respect to deal pipeline in US? Again, in this quarter, no major surprises coming in from US as well.
Yes, so even if you follow the commentary across the... Yeah, can you hear me?
Yeah, go ahead, Milind.
So basically, if you follow the commentary across the news and from the industries interactions, yes, there is a slight bit of curtailment in terms of growth expectations, but if the client interactions have suggested from the companies that they do not face any issues per se from America. The ordering is up, although the deal sizes are getting smaller, but the ordering is moving up and is likely to move up. Although there might be all in all, if you look at the overall spend impact on the overall IT spend, yeah, there might be some impact with a lag, but we do not expect it to be significant.
Dipesh, where do you think TCS stands versus the rest of its peers? You saw Accenture's performance. Accenture has clearly pointed out that there will be volatility. From a purely comparative perspective with its immediate peers, where do you think TCS stands? Are they still on a strong footing, irrespective of the possibility that Q4 may be incrementally lesser than the first half of the calendar year?
So if I look from revenue performance, even this quarter, performance remain broadly in line with expectation and remain very healthy. Even if you compare, and it is among top-notch kind of performance, so they continue to deliver top quartile performance. margin is the area where they have disappointed to the expectation kind of thing. I think better clarity on that part may address some of the concerns prima facie comes emerging from this quarter's performance so far. So I think margin is the area where people require more explanation. I think revenue broadly what people were expecting from the TCS kind of thing.
Okay.
From a big picture perspective, I think the main thing here is that the numbers were better than feared. That's how I kind of look at it. Remember, we've had some incredibly volatile macro environments starting in September, ending in December. And one of the biggest fears was that we were going to see some sort of an impact on spending patterns, and we have not seen that. That's a big deal. That's probably should be the biggest headline here. We actually released our spending survey a couple of days ago, and it kind of told us kind of the same thing. The buyer has been resilient. That should probably be the number one headline here. The margin miss that we've seen is a function of investments. All these companies in the space have been reinventing themselves, and they have to reinvest in their business, whether it's digital, whether it's shifting their delivery capabilities on-site, etc.
We have had a fairly strong quarter in a seasonally weak set of period. We are ending the quarter with a revenue of 37,300 odd crores. And in dollar terms, that's $5.25 billion in revenue. Importantly, it's the growth on a constant currency terms is 12.1% on a year-on-year basis. And in dollar terms, we now have closed calendar year 18 with $20.5 billion of revenue for the calendar year. And that's a growth of 10.3% in dollar terms from calendar year 17 to calendar year 18. Overall, the rupee growth is at 20%, aided by currency benefits. And for the quarter, the year-on-year growth for Q3 to Q3 is at 9.7%. The growth has come with a good margin defense. We are ending at 25.6% for the quarter. And on a year-on-year basis, that's an increase of 44 basis points. And growth in terms of the annual operating profit growth of 22.9%. We are on target to improve our full-year margins on a 9-month to 9-month basis. This is an improvement of 118 basis points at an operating profit margin level. Coming on to net profits, we have crossed another big milestone in our journey, crossing 8,000 crores of quarterly net profit this quarter, ending with 8,100 crores of net profit, which is a growth of 21.7%. Rather, it's a margin of 21.7%, and translates at an EPS level to a growth of 26% for the full year, for the year-to-year basis. Similarly, we are quite happy with the cash conversion. We generated 8,600 crores of operating cash from operations this quarter, which is a cash conversion of about 107%. We are ending the quarter with 43,800 crores of cash and investable surplus. So overall, a fairly strong set of financial performance, and it is coming on the base of very strong business growth. I'll touch upon parts of that. Firstly, from a customer portfolio perspective, we have seen expansion across all customer portfolio levels. We have now added one more customer in the $100 million plus range from a quarterly basis, and on an annual basis we have added 8 customers. So we've gone from 37 customers to 45 customers in this band of 100 million plus. From services perspective, digital continues to power growth. We have now crossed 30% of revenue coming from digital, and it's growing at more than 50% year on year. From a segmental perspective, North America growth acceleration continues. North America year-on-year growth has now come in at 8.2%, and Europe and UK continue to do well, which is continuing a trend that has been there for the last few quarters. The growth from industry segment perspective, very encouragingly, BFSI continues to accelerate its growth trajectory. BFSI this quarter is at 8.6% year-on-year growth, with strong growth coming from North America, from insurance, and very broad-based growth across the insurance segment. And as I said, from North America, despite some impact in UK and Europe on the banking side of it. Retail, in a very seasonally weak quarter for retail continues to maintain its greater than 10% growth rate at 10.5% on a year-on-year basis. And other segments which have been showing good growth, like life sciences, healthcare, energy and utilities, all of them have continued to deliver well on the growth journey. So overall, strong quarter, strong pipeline. Our order book for this, or rather the total contract values closed in this quarter, which is at $5.9 billion compared to $4.9 billion last quarter. So good order closure into this quarter, strong pipeline build-up also. And from a manpower perspective, our attrition continues to remain very low, industry-leading retention. And we added 6,800 new headcount, net headcount in this quarter, and totally 27,000 for the year. This compares to a net addition of about 7,000 last year. So very strong demand being serviced with a very strong addition on the headcount and on the capacity side. So overall, a strong quarter to wrap up the calendar year, and a strong pipeline and strong order flow that sets us up nicely going into the new calendar year. With that,
First up on TCS, because that one reported a mixed quarter. The dollar revenue was in line while the margin missed estimates. Reema is here to tell us the key highlights. Reema, while there were no fireworks in the numbers, it wasn't a howler as well.
Well, the margin miss takes the sheen off the company's otherwise solid growth performance. So the big miss this time is coming on the margin front. The company has reported margins of 25.6%, much lower than estimates of 27.6%. It's declined by 90 basis points on a quarter-on-quarter basis. The two key reasons for that: one has been the cross-currency headwinds on account of the fact that the dollar's depreciated against the other currencies, and secondly, on account of the higher cost of doing business. So on account of the talent crunch in the US, for instance, the subcontracting costs went up by nearly 35% on a year-on-year basis, and this seems to be an industry-wide problem now, that the on-site cost structure seems to be rising, and that will put pressure on the company's margins even in the coming year. That said, on the growth front, it's delivered well. So constant currency growth of 1.8% on a quarter-on-quarter basis, within, in line with estimates. On a year-on-year basis, it's 12.1%, the highest that we've seen in the last 14 quarters. The digital growth continues to remain strong. It's accelerated by 52% on a year-on-year basis. It now contributes over 30% to their revenues. BFSI also continues to accelerate. On a year-on-year basis, BFSI has grown by 8.6%. The order book has gone up 20% on a quarter-on-quarter basis. So the total contract value of deal wins stands at $5.9 billion in the quarter gone by. And there has been an increase in the $100 million client addition as well. So on most parameters, especially on growth, even in terms of the management commentary, they fairly sound upbeat. They're on track to end the year with a double-digit growth. But it's the margin miss which is a bit of a worry, and that's caused analysts to scale down their margin and EPS estimates for the year and perhaps even for next year.
Where we are, we see strong deal momentum. As I said, the order closure this quarter has been steadily increasing. It's grown almost 20% compared to last quarter. And on the pipeline front also, we are seeing steady build-up of it. Our deal pipeline, adjusted for the one-off platform deals that we had, we are much better than where we were last year.
Well, there is a margin miss, and that's a reason for the stock, for the people to be disappointed in TCS this time around. Margins have missed on account of cross-currency headwinds as well as a higher cost of doing business. So we have seen an increase in the subcontracting costs. They've hired more people locally, as a result of which the on-site costs have gone up. So margins have come down to 25.6% versus 26.5% lower than estimates. CLSA has cut the margin estimates not only for FY19 but all the way till FY21 by 50 to 70 basis points. The other parameters like constant currency growth, the deal wins, the BFSI numbers are looking good this quarter. Kotak has lowered the target price to 1825 versus 1950. They have a reduced rating on account of stretch valuation. CLSA reiterates its buy call on account of industry-leading growth, but they too have cut the target price to 2460. The key from here on is whether FY20 revenue growth for TCS can accelerate from FY19 despite the macroeconomic concerns that are surrounding it. And secondly, this higher cost of doing business, is that going to erode into the margins, not only for this year, but even for the coming terms? Is this going to be a structural issue for the company and for the industry? Is something that we need clarity on.
Okay. Hi, morning. I don't know if you heard the management of TCS, but they did mention that double-digit growth is possible in FY20. They were very confident. Also, they said that this margin erosion that they've seen this time is just a minor blip because they're investing in hiring in order to cater to demand. Would you be optimistic here?
Yeah, morning. So I think the management commentary was very positive, and I just heard a little bit of it. But yesterday numbers were definitely a little disappointing. 100%, 100 bips down on the margin. The problem is, Sonia, even though the management sounds confident, I think the escalated cost of visa and so on are going to be a detrimental point. Now, how they play it is a very stark contrast to how you've seen the guidance from Apple and Samsung in the sales over there. So we'll take it with a pinch of salt. I think the stock is fully valued, but as a portfolio pick, it has been a primed on a 40% up in last year. I see it being a market neutral for the time being.